Hello, I am Matt Parrott, a Chartered Tax Advisor with Wellington Accountants, Tax Shop Accountants. Today a very short video on pension regulations for the higher rate taxpayers. So people paying into company pensions or personal pensions where they have very high incomes, and the potential pension trap, as I like to call it, whereby they can end up getting a tax bill on pension contributions they or their employer makes. So as we stand, there is currently a £40,000 annual allowance. Now that means you and your employer can make a maximum of £40,000 into an approved pension scheme and get full tax relief on it. If you pay more than that amount, there could be a problem. This is for higher earners from 2016-17. So for this to apply, the taxpayer would need to have income over £110,000, which the government call threshold income, and an adjusted income of over £150,000. An adjusted income basically means total income from salary, savings, business, whatever, all added together, plus added onto that the contribution from the employer. Okay, so the probably the easiest way to explain this is to actually give you an example, and it's an example of a client of mine who asked me to do a calculation. He just had a large salary increase, his pension had gone up as well, and he wanted to know what his position was for 17-18 tax year. The date of doing this video, it's February 2018. So this guy, his salary for 17-18 is going to be £250,000. He pays £40,000 into a pension. His employer matches that, and they put in £40,000 as well, which means he has a total pension going into his pension pot, total amount going to his pension pot of £80,000. Because his income exceeds the £210,000 threshold, he loses all but £10,000 of his annual allowance. So his £40,000 allowance reduces to £10,000, which means he had £80,000 paid into a pension. He's only allowed £10,000, so that extra £70,000 is going to cost him 45% of £70,000. That's £31,500. I've had to email him this and told him the bad news, and he's not going to be very happy. Once you get over the £150,000, your annual allowance of £40,000 reduces £2 for £1 down to £10,000. So from 40 down to this £10,000 figure. You can use unused reliefs for earlier years, for 3 earlier years, which can help with the calculation. However, the message, in particular for this client of mine, my advice to him was reduce your own contributions to £10,000, and rather than your employer paying £40,000, ask them to pay that to you as a salary, as an extra salary, because it's stupid paying the income tax on it now at 45%. It goes into a pension pot, and then when he comes to draw his pension in later years, he's going to pay tax again on it. So it's absolutely ridiculous. So beware. Earners over £110,000 or £150,000, whichever way you look at it, do the calculation. It can be very, very expensive mistake. Thank you.